So imagine stepping up to a casino table, right? You place a bet, and you realize that if you lose, you don't just lose your chips.
That sounds like a terrible casino to be in.
Right, because you could theoretically owe them an infinite amount of money. Today, we are doing a deep dive into the chaotic engine that recently brought Wall Street billionaires to their knees. By the end of this, you will understand exactly how the wildest market events actually happen.
We are, of course, talking about short selling.
Welcome to everything you need to know about finance.
And before we jump in, just a quick housekeeping note. This deep dive is strictly for educational exploration, so it is not financial advice.
Yeah, exactly. If you find this kind of content interesting, please like and subscribe.
So to really grasp short selling, we have to kind of flip the whole buy low, sell high idea on its head.
Right, so let me try an analogy here to see if I get it. Imagine your friend has this hyped-up new gaming console that costs like $500.
Okay, I'm tracking with you.
You borrow the console from your friend, and you immediately turn around and sell it to someone else for that $500.
Which is a bold move, but go on.
Well, you still owe your friend a console, right? So you just wait for the hype to die down. A few months later, that same console is selling for $200. You buy it back, return it to your friend, and you just pocketed the $300 difference.
That is a really brilliant way to explain it. And translating that to stocks, you're borrowing shares from a broker, selling them at market value, and just hoping they drop so you can buy them back cheaper.
But wait, if a normal stock crashes, you just lose your initial investment, right?
Yeah.
There is a floor to your losses.
Yeah, exactly. Zero is the absolute floor.
But what if that gaming console's price doubles or even triples? Like, you still owe a console, no matter what it costs.
Right. And that is the trap. Since a stock's price has absolutely no ceiling, your potential losses as a short seller are literally infinite.
Oh, wow. That is terrifying.
It really is. And because of that infinite risk, brokers require you to keep cash collateral in your account. If the stock price goes up, they issue a margin call.
Meaning they demand more cash from you immediately.
Exactly. And if you can't pay it, the broker automatically liquidates your position. They force buy the shares back at whatever the crazy high price is just to protect themselves from your bad bet.
So how does one trader getting a margin call turn into a massive market-wide explosion?
Well, it creates a chain reaction called a short squeeze. We saw this back in 2008 when Volkswagen briefly became the most valuable company in the world.
Right, and we definitely saw it in the 2021 GameStop saga too.
Oh, absolutely. Retail traders, inspired by folks like Roaring Kitty, deliberately bought up shares to squeeze the hedge funds that were betting against GameStop.
And looking at the data for GameStop, it had over 148% of its shares shorted.
Yeah, which sounds literally impossible, but it happens because shares get lent out and shorted multiple times.
It's just this crazy self-feeding loop,
Yeah.
The panicking short sellers are forced to buy shares to cover their losses, which just drives the price even higher.
Exactly, and that higher price triggers even more margin calls, which forces even more buying. The people betting against the stock are ironically the ones shooting its price to the moon.
Wait, so isn't it inherently toxic to root for bankruptcies and layoffs? Like, making money off a company failing just feels wrong.
Well, that is definitely the common criticism, the moral gray area, but there is a watchdog perspective here too.
Really? How so?
Because short sellers actually have a massive financial incentive to dig through corporate filings and expose fraud. They were the ones who first sniffed out massive scams like Enron and Theranos.
Oh, that makes sense.
Yeah, and even Michael Burry used a similar mechanism to warn the world about the toxic housing bubble before the 2008 crash.
Okay, I see. So looking to the future, heavily shorted stocks are going to remain these volatile battlegrounds where market psychology and raw financial strategy just collide.
Yeah, so if you see a sudden, inexplicable market spike, remember there is almost always a hidden story of forced buying beneath the surface.
Which makes you wonder, with algorithmic trading dominating everything, could future short squeezes happen in just seconds rather than weeks?
That is a pretty wild thought to leave you with.
It really is.
Yeah.
Thank you for taking this deep dive with us today, and try out our latest episodes.